Welcome to Progress Partners Macroeconomic Outlook webinar. We appreciate you making the time in your busy schedules to join us today. For those returning, thank you for your continued engagement. And for our first-time attendees, we're delighted to have you with us. It's now my pleasure to introduce Chris Legg, Senior Managing Director at Progress Partners, and Adriaan Muhlen, Managing Partner at Progress Ventures, who will guide us through today's insights. Take it away.
Thank you, Anne, and welcome everybody. It's been an interesting few months since our last update, and we're really going to try to look at all the data and parse it up and give you our short-term and medium-term view. And the headline is, there's actually a fair amount still happening in the private market, despite the volatility you've been seeing in the public market. I'm Chris. I'm one of the people who run the investment bank. I'm with Adriaan, who runs our venture arm. Just as a reminder, in terms of who we are, the investment bank here is on the right. It's what we call the wheel. And selling private companies in the tens of millions to hundreds of millions is sort of our bread and butter. As I always say, if you give us any reference, you'll hear one word from us: thank you, in terms of any new possible transactions or deals. We'll look at anything. On the buy side, has been a big part of our business in certain years, and this year as well, with a lot of opportunities out there, and then capital raise. And then we'll talk about the venture arm in a little bit here. The sectors on the outside are really been our focus areas for us. I always say we're not a high volume shop, we're high touch. We completed a transaction earlier this year in the influencer marketing space. That was Content Lab, which we sold to Sammy. We just completed a transaction at the last day of April, which has not been publicly announced yet. We have a number of transactions that we think will close here in the next few months. So we are tracking for a decent year.
And this is our venture portfolio for our current funds. And we'll talk about it more, but this is our fourth fund. It's focused on data management, AI, media automation, and measurement and analytics. We're nearing the end of this fund, and we've completed our portfolio, and we're really focused right now on helping those companies grow as fast as they can, and we'll be launching our next fund later this year.
Thank you. So with that, let's get to the update and where we're at. And here's a good dashboard to sort of kick us off.
Yeah, this is the dashboard that we've shown you in prior sessions of this. We've made some updates to correct it forward to 2025. What do we know so far, and where do we think we're going to end up at the end of the year? On the key metrics. On GDP side, clearly, 2024 was not a bad year. But things have started to slow in going into the new year. Inflation came down last year. Labor market reached stability again. Interest rates, we had a lot of cuts, and we were expecting a lot more cuts this year. And then we've added a new one at the bottom. Is the deficit, U.S. deficit, because it's a key topic in the news and what we're focused on. And projections are for kind of a $2 trillion deficit. So where are we so far this year? I think things have slowed down more than expected. Q1 GDP just came out with a negative number. We still think we're going to end up with a positive number for the year in the 1% to 2% range. Inflation, we think there's risk for that to go up this year again, call it in the 2% to 4% range, so hopefully not beyond. On the labor side, we actually expect it to be relatively stable because there's a lot going on underneath, but net, I think we expect to remain at full employment. And from an interest rate perspective, a lot of debate. We are in a way, what we say, halfway through in the cutting cycle from the Fed. I think the Fed would like to get down to 3.5%. We're not sure we'll get there this year, given what is happening with inflation. But we certainly expect more cuts this year. And then from a deficit perspective, there's a lot of conversation. We are very hopeful that there will be a reduction, because I think it's necessary. But we think there's also a real risk that the deficit may end up actually being larger this year due to decline in revenue coming in, additional expenditures. So this is one we're really going to be watching, and one that Congress is very much focused on. But unfortunately, we're worried that we could actually end up with a larger deficit rather than a smaller deficit.
So we're going to break down all these points in the next couple of pages. And with that, we'll start at the top, which is GDP. As Adriaan mentioned, it will be lower this year. We do not believe there'll be a recession. And a couple of themes here on this page. One is that sort of light green, that's where the Goldilocks kind of, 2 to 3% range, not too hot, not too cold. That's where we've been for a lot of really the last decade in this century, except for the great financial crisis. And then of course, the beginning of COVID. We're going to be below that this year, to Adrian's point. We'll probably be in that, 1% plus or minus range. And that's not a recession, but it will feel not great compared to sort of where we've been the last few years and really for a large part of the last 20 years. On the bottom, this is quarter, and you can really see the quarterly volatility. So to Adrian's point, while Q1 was slightly negative, Q2 will most certainly be negative. That we're still predicting positive for the year, and it does bounce around from quarter to quarter. So don't get too influenced by the quarterly fluctuations, but we will end up sort of at a lower percentage for this year. Again, we still believe slightly positive.
Yeah, and just effectively the Q1 number was less negative than we had thought. A lot of reasons for that, but I think we should be prepared for a pretty negative number Q2. Again, while we think it will turn back up. From an S&P earnings perspective, I think this is also a very important one to look at because this ultimately powers the equity markets. Or last year, we had looks like numbers are still getting finalized, right? A positive growth year, and we expect a positive growth year this year, quite materially still. Now, key here is right, what drives earnings, right? Part of it is revenue, right? Revenue growth, and the other one is profitability. And similar to the last couple of cycles, businesses have gotten very good at getting ahead of declining growth and cutting aggressively. And we expect that to happen this year as well. And as a result, you can have earnings growth that is actually ahead of GDP growth. And so currently, right, and I would say currently is a key word here. The market is expecting still a 7% growth rate earnings. Clearly that could come down, but we expect it to be a positive number for the year at this point.
Yeah, as you always say, it's tough to have a recession when earnings are sort of flat or growing. You can see it happened in 2008. You can even see it happened in 2020, where the first half of the year, much like this year, was challenging. This was the start of COVID. And really what you're seeing now is a lot of companies saying uncertainty for a latter part of the year, but generally produce good results for Q1, and many are guiding towards okay-ish results for Q2. So again, that supports the theory this will not be a drop-off for 2025.
So key to the U.S. economy has always been the consumer. And here's our kind of snapshot on how the consumer is doing. And you still see a lot of green. And this is one of the reasons why I think we feel pretty comfortable. Yes, consumer debt has been growing. And I think it's good to have more credit out there available to fund spending. Delinquency rates, more importantly, are still low by historical standards. Yes, they have come up. But they were artificially low during COVID. And we're not all concerned about where they are right now. And if you further look at kind of household debt service payments, they're also still at very sustainable, normal levels. So from a consumer balance sheet perspective, we are at this point not concerned. Again, this can change, but at this point, I think the consumer has room to go. But in this kind of the final chart here, consumer sentiment has been declining very rapidly over the last couple of months. How consumers are feeling, and that of course impact how willing they are to spend. This is really pretty dramatic decline. Not entirely surprising given everything that's going on. And I would say, this number you need to be a little bit cautious because it's very volatile, right? It can easily bounce back in another month, but it is right now declining very rapidly. And so we're watching that very carefully because that ultimately will translate into, consumer spending habits, or activity. If it sticks at this level, that's a problem.
And one of the things that certainly drives sentiment is inflation or perceived inflation, which is a good lead into the next page, which is really kind of a couple of things happening on this page. One is, on the left side, so you see over really this century, the first 25 years, how CPI as a proxy for inflation and Fed funds, the interest rate, kind of moved generally close to how out of whack they were. When 21, when we had 8% inflation and interest rates at 0, they're much more in sync now. You've got basically Fed funds rate at low fours. You've got inflation, kind of in the low threes, and that's why you see that on that graph on the top left. They're generally not too far off, and that's a good thing. What you see on the right is really what the drivers of inflation have been and why it's been a little bit stubborn and coming down. And the stubborn piece has been really much around, in the shelter side and housing. And, that's a lagging indicator. Remember, economics leading and lagging in terms of shelter costs, but it's been stubbornly high in keeping inflation. And now you have some of the core potentially with the tariffs potentially has a chance to come back.
Yeah, and what I would say is our feel is the real inflation number right now is probably closer to 3%, based on some of these these subsets as we look at it. But we are expecting an increase in the coming months. Partly it's tariffs, partly it's expectations of people, and so the question is, does that stick, or does that get reversed, and do we end up going back into kind of this declining cycle that we were last year? Too early to tell, but the coming months will say a lot. So we're going to be watching this very carefully.
We will, and that's going to lead into the labor market.
So key concern during COVID was the labor market and things were going, and you got some very weird things that happened in the labor market. In the charts you can see, but so far, we said like last year we returned to kind of a normal, stable labor market, right, in that 4% range, full, relatively full employment. So far this year has been very strong. Right now, again, these numbers, can change quickly, and certainly expect them to be less, solid in the coming months. But the labor market right now, people are working, and if people are working, right, recession becomes, more difficult to happen, and so again, can change. Lots of things going on, but we really have bounced back well from COVID. From a labor market perspective, and are in a sustainable kind of place right now.
So labor market, good. Interest rates, anyone who knows, I like graphs for sort of 70 years of time frame. This goes back to 1955. What you really see in this is just how unusual the interest rates in sort of the mid to high teens in the early 80s were. And also, conversely, how unusual from 2010 really through to kind of 16, 17, interest rates at zero were unusual. And they don't publicize this, but the Fed sort of natural rate that they'd like to see is around 3.5%. And you can kind of see, actually, to my point, around 4.3, we really aren't that far away. And that's why Adrian's point about, we'll get to that. We'll probably get to it at some point next year. We're not that far away, though.
Yeah, we're already halfway through the cutting cycle. Looking at it a little differently is the yield curve, right? This is the return on debt at various maturities, or the cost of borrowing at various maturities for the U.S. government. Last year was a lot of talk about an inverse yield curve. It was very inverted, right? You got paid more for shorter maturities than longer maturities. Always been an indicator of a recession. Yield curve this year has returned back to normal. It has become steeper, and has actually in the past month become even steeper. Now it's not all good news, because especially the longer maturities, the yield has increased pretty dramatically, and this is a risk premium effectively for that investors require for holding U.S. debt, given kind of all the turmoil we've had with tariffs and the new administration. The government has to pay more to borrow, and so and we've been watching this pretty closely, and these numbers have bounced around a lot. When there's conversations about tariff talks going well or tariffs getting reversed, yields have come down, but we need to be very careful about this, because if at some point the risk premium becomes too much, we really lose control of our ability to borrow as a country. And so, we'll be spending more time on this as well. Something that's less talked about is the Fed balance sheet, but it really goes hand in hand with the interest rates. This is the Fed buying assets in the market and thereby injecting liquidity in the market. This was a tool they've always had, but really for the first time started using very dramatically in the '08 financial crisis. And it kind of looks small right now because so much has happened since. But that was really key to kind of saving the financial system during that crisis. With COVID, they repeated that playbook and really massively injected cash into the economy to keep things going by buying assets from people and giving cash in return. For the past 2 years, they've been trying to bring that balance sheet back down by primarily letting things mature, but we're still at a very elevated level. And so as they let things mature, it effectively has the same effect of increasing interest rates by taking capital out of the market. Impacts different parts of the market, but it is a way to increase or reduce economic activity. And key thing to note here is it's still very elevated. Yes, the Fed can buy more things, but at some point you don't want to have a Fed that owns too much of the national assets or the national wealth. They've now signaled they're going to slow down here. Worth watching. And again, keeping in mind there's another tool that the Fed has if it's needed to intervene.
Yeah. One thing you'll remember if you've heard us in the past talk about what a game changer AI is, and it's been talked about. I guess our theme here is it's here. We're seeing it. We're seeing the changes in our own business, in our clients, and our portfolio. But this just gives you a snapshot of the amount of investment that's been made. And then the graph here on the top right, that's by VCs in AI, record number 2024 at 62 billion. Even capping that and bigger than that is the investment by corporates. At the bottom here, we have 4 of the Magnificent Seven: Microsoft, Meta, Google, and Amazon. Collectively have put over 100 billion. Again, the VCs put in 62 billion into AI investments. So there's a lot of money. This will be a big game changer in much the way the internet was 20 plus years ago, and look to a lot of knock-on effects for that. And that's one of the reasons we're bullish over the medium term.
Yeah, and just when we spoke to you in December, we said this is likely to come, but we're not seeing it yet. And it's really been pretty dramatic what we've seen during this first quarter of this year. Companies are adapting these tools and are using them to do more with less and do it better. And just we're literally we talked to all of our portfolio companies. They're all using these tools now. They weren't per se last year. They were experimenting, and it's really rapidly getting adopted. And so we expect, like Chris said, this is going to be a similar boom to what we saw in the late 90s with the internet from a productivity perspective. And it's here. And so despite all the uncertainty in the world and in the US economy, this is a good thing. And we expect it to be a key driver of growth going forward.
Definitely over the next 3 to 5 years. So sort of going high level from AI to really sort of the world macro economy. A couple of themes here, and there's certainly talk the last few months around the change of the U.S. disposition in the world, its own sort of Brexit out of the world economy, loss of hard power, soft power, and even potentially some economic power in the short term. But what this should really drive home is just how powerful the U.S. is in the world economy today. By far, the largest economy on a size range. It's about 26% of the world economy. It's also the highest per capita by a long shot. And just to put that in perspective, the size of the U.S. economy and the euro around 2008 were roughly the same size. The U.S. economy now is 50% bigger, both in size and a per capita basis. Even if you go back in the mid-90s with Japan, Japan was 50% bigger. Now we're 150% bigger, the U.S. economy. So my point in saying all this is we're going to have a softer year for sure in the U.S. The other countries in the world are sort of, have a chance to sort of catch up a little bit, but the relative size difference is still very credible and large, and that's not going to erode anytime soon. Going even higher level, we've talked about this page many times, and it's a page we really like, which is really around kind of, what are the more macro risks? Deglobalization, again, it's been in swing now for a good 10 plus years. Brexit in 2016, even COVID and some of these wars do cause global supply chains to be reoriented. And now, as I said before, the U.S. is sort of doing its own Brexit to some extent of the world economy. As Adriaan mentioned, these sovereign debt levels, the U.S. certainly and other countries in the Western world are becoming significant. That's going to become a real risk. And sort of climate and energy and how those get rejiged. Those are happening in real time. In some level, the ones below are the ones really to watch for. We talked about sort of the U.S. dysfunction. There's now a majority one party, but we have a sort of a separate issue, which is the U.S. position now in the world, which is changing with the tariff and trade war, and kind of this U.S. go-it-alone policy. Fiscal discipline is going to be key for all the Western countries. It'll be really interesting to see how the U.S. plays that out in 2025, especially as it relates to tax policy. We've had some wars, certainly in Israel and the Palestinians for the better part of the last year and a half, and of course Ukraine and Russia for over 3 years. These have largely been contained from a market perspective. They always have a chance to sort of blow up beyond that. And even recently in the last few days, you now have India and Pakistan as a potentially emerging threat. I don't want to downplay the humanitarian risks of these, but from an economic standpoint, they've largely been contained. And then probably the one that on the far right here that's got the most challenging near-term volatility and teeth to it is a continuing deterioration with China, which was part of a sort of a cycle that's been in place before Trump took power, but certainly he turned up the volume on that. And that's going to be interesting to see how that plays out in 2025. So with that, we're going to sort of now move into sort of the markets, what we're seeing specifically in that. You know, on a macro side, these used to be more green, I'll say that. We talked about instability brought on by most of the current administration. And, you know, people don't like instability or uncertainty. So our view is that will get much calmer over the next couple of months. But certainly Q2 has sort of been a record for political and rhetoric on sort of economics. There's still a tremendous amount of pressure amongst the funds to deploy capital. That's something we're going to talk about in the next couple of pages. The debt market's been pretty active. It's come off a little bit to Adrian's point about sort of shifting yields. And the IPO market's been generally you know, opening, I would say, the last year. It took a step back in the last month, but good companies are coming to market. They will not come to market in volatility like we had in April. But as long as the market stabilizes and it's showing signs of it, they will come to market, and there's good companies lined up.
Yeah, and what is underappreciated in some of these last cycles, there's actually a remarkable number of really good companies eager to go public, ready to go public, and so all we need is a little bit of stability, and that could also be a real boost to getting the flywheel going on the deal side, and you know, have a lot of ripple effects down towards kind of the venture side of things.
Yeah, the companies we deal with typically don't go public, but it helps to your point about being a flywheel. I always call it lubricant for the entire market. So let's dig in a couple of these. So on the M&A market, it's a market that's obviously near and dear to our hardest practitioners. We are seeing, you know, as we said, 2025 is going to be a fine year. We closed the deal at the very end of April. We'll close some more deals this year. It hasn't been as volatile as you see in the public markets in terms of just sort of the price changes, sort of the appetite. We'll get into some of the drivers that a little later on. But you are seeing sort of, you know, part of a swing up of deals, bottom sort of being 23, the peak being kind of 21, a kind of emergence of the private deal environment.
So on the venture and private equity side, again, you know, it's too early to tell for what's happening in 2025 because data is still coming in. 2024 was fine, not as robust as some of the prior years, but things are happening, and our sense is things are still happening here in 2025 as well. From an interesting observation here on the venture side. Venture activity is actually up significantly in terms of new investment here in Q1. It is already ahead of last year, and you may say, "What's going on here?" What we think and what we believe is that is mostly AI driven. It's just a tremendous amount of money flowing in there. There's really big deals getting done, so it's swaying all the numbers, and so this should be a really good year from a new investment perspective. From an exit activity perspective, there has been some already quite materially this year. Not quite clear where it's going to head. I mean, there's clearly a lot of backed up companies sitting, ready to exit, and that we've been waiting for years to come out. Let's see where that goes. New investing activity is up significantly. And if you look at it from a fundraising perspective, it's actually an interesting story as well. Private equity fundraising is down. You're certainly down this year, and we're interested to see where it ends up. But it's been down for a number of years now. It's become a very crowded space. A lot of capital still sitting on the sideline. But on the venture side, which normally tracks exactly the same way, fundraising activity is actually up. And again, we think that is all AI driven. We expect that to continue this year. Now, the venture numbers are smaller, but this could be a very big year from a venture fundraising perspective.
You want to go ahead?
No, go ahead.
Sure. Private equity backlog is real. And what this means is, typically these funds, whether it's VC or private equity, like to be out in, 3 to 4 years, 3 to 5 years. And what we're seeing here is a lot of assets that have been sort of 7+ years. So there's a real desire to that. On the top right, you can see there's 760 billion, just a sort of private market value of 7 years and above. Again, some of those being 10+ years. And sort of a high percentage on the bottom right of sort of percentage of portfolio that's now quite mature. So what this means is there's a real driver for these funds to find liquidity, because if they can't get liquidity, then they can't go out and raise new funds. And so that whole machine just needs to keep moving. That's why we're seeing not too much of a pullback in 2025, despite a volatile period here.
And valuations expectations are starting to become more realistic, right? Part of it is you had a big bid-ask, spread, and over the last couple of years, and that is now starting to adjust. So separate from where the economy is, we expect sellers to become more realistic, and so that will loosen up some things, but there's a real need for that to happen.
Yeah. The IPO market, so big part of the sort of highlight in 2021 was SPACs. They were a huge driver, but in general, a lot of stuff was going public during that period. It really dropped off in 22 and 23, but you see it sort of slowly coming back, and 25 was on sort of cycle for that to happen. And as we said, it was happening in the first quarter. It's taken a step back in a sort of a volatile April and more volatile Q2. But as a year, we generally think IPOs are going to happen this year and have been happening.
Yeah, and just to talk about a little bit more about the dry powder issue, this is the capital, over 1 trillion of uncalled capital going into US private equity. This is commitments people have made, but that have not been deployed into deals. It's a very significant number. It has come down a little bit over the last year, partly because of the slowdown in new fundraising from buyout funds, but it's still a very big number. It creates a tremendous amount of pressure in the system to try to get deals done. And so it's in a way, if you're eager to get deals done, right, this is a good thing to have out there. But it's also kind of a systemic issue that needs to be resolved, because while this capital is sitting out there, people are not really wanting to commit to new funds. So watching it closely, and be curious to see where exactly it ends up this year. But a huge wall of money waiting to be invested.
So a big part of the machine, we talked about, the maturity of some of the companies in the portfolio. If you think about a rule of thumb for private funds, is they typically need to give sort of a fifth of their capital back in a year. So you see that sort of plus 25% for a lot of the last decade. That has been well below those levels by about half. So 10% plus or minus for the last 3 years. Yeah. They need to get more liquidity. They need to give money back again for the whole machine to work.
Yeah. And you may have heard a lot about the secondary market, and the secondary market in a way certainly can address some of this. But the numbers are so large that it still very much overwhelms the system. And so to get it going back, we need to really see numbers above 20%, and probably even a number well above that for a year or two to kind of clear things up.
Okay, so now we're going to go to the debt market, and I'm really going to give it to you to give a quick summary of what's happening.
So this is a snapshot of loan activity. 2024 was very robust, and you say, why is that? Well, interest rates came down a lot, right? Everybody was waiting, and interest rates came down, and then when things became a little less certain, people said, let's take advantage of this. And so there was a huge amount of repricing, refinancing that happened last year. And if rates keep going down this year, and again, that's the question is if and about how much, we expect that to continue, right? People want to swap out expensive debt for cheaper debt. Yeah, clearly that happened last year. Defaults, something to watch, closely as well. They're really quite low. Nobody is really defaulting. It's been historically low for a long time. Now, part of it is people have gotten smarter about it, and they're pre-negotiating and working out situations where trouble is likely to arise. But we're still in a very healthy situation from a default perspective, and we really don't see any signs that is about to change significantly, to like what we saw in 2009 or in prior recessions. So relatively solid position from a default perspective. Looking at the spread, high yield versus the kind of the risk-free rate. Again, also historical lows last year. Yes, interest rates were high, but the spread, the premium for taking on high yield debt was really quite low. That has become more turbulent this year, and I don't really have good data for you yet here. But we expect that similar to kind of the Treasury, the lift in rates there. We expect the spread to break out more as well, and specifically if this turmoil continues and more companies get into more challenging situations. And so we'll keep tracking it, looking at it. But his last couple of years, really the premium for high yields really came down.
Debt has been a big part of the game for buyouts, less so for venture. The point of this in the bottom right is to show that debt coverage ratios are actually reasonably healthy. They peaked at 6, 5 is a good number. That's sort of where they're at right now. Okay, so now we're going to sort of bring it all home with sort of a review and sort of what's happening from a government perspective.
So big topic of the year is the U.S. federal deficit and debt levels. The U.S. fundamentally takes in less revenue than it spends. Last year, about $2 trillion. You can fix that by either bringing in more revenue or reducing your outlays. Key thing to notice, doesn't need to be a perfect match. To have a sustainable level, we think you need to reduce it by about $1 trillion. Running a 3% GDP deficit is sustainable, especially if you're growing 3%. But this $1 trillion that needs to come out is a difficult number to get out. We personally believe a significant part of that needs to be through raising taxes and bringing in more revenue, because a lot of the outlays are not really cuttable, right? And when we heard a lot about the DOGE programs, they were talking about cutting $100 billion maybe here or there, but you need to look for much bigger numbers. And we really don't see a place to do that to a very large extent, other than to bring in more revenue. And again, I think it's doable, but this is the key issue of the moment.
And this just drives home how significant the debt, public debt in the U.S. has become as a percent of GDP. Everyone sort of has their numbers of comfort, but suffice to say, sort of in this 120–130% range. Again, U.S. debt to GDP, that's the graph on the left, is sort of in that 120 plus range. That's high by historical standards, by economic comfort standards. And you see that on the top right in terms of some of the effects of that, which is, interest costs are now becoming, in terms of the government having to pay interest on this debt, is becoming higher than, a lot of other categories. Back to Adrian's point about DOGE, like this is a significant category. It's not good. Over the last 10 years, that interest has been $3 trillion. Over the next 10 years, if this isn't corrected, it will be $12 trillion. So 4x the amount it's been over the last 10 years as public debt increases.
Yeah.
And it has to be rectified.
And it's a real shame, because everybody always was worried that the U.S. had high debt, but it actually didn't. it was relatively low from an indebtedness perspective, but that just, we literally doubled that, since the beginning of COVID, and the financial crisis. And so it's a very, poor management, and an unnecessary problem we have created for ourselves. And just a little perspective on the tax side. Where does revenue come from in the US? We talk a lot about corporate taxes, but it's really all about individual income taxes and payroll taxes. That's where the revenue comes from. Custom duties or tariffs, really not a factor. And also, we'll talk about it more later, but it's really not a potential to be a big revenue source. And if you look at it, what are people paying, right? And it's doesn't include state taxes, but on average, people, and especially compared to, I don't have that chart here, but some of the European countries, U.S. tax, marginal tax rate are not that high. The upper incomes, right in the 30% range. And so and I'll show it on the next slide, but that's we're gonna have to bring these numbers up. This just looks at it, who pays the taxes in the U.S. Half of it comes from, shouldn't be surprised, but from the top quartile of earners, and they bring in about 2/3 of the total federal taxes, and unfortunately they're gonna have to pay more because there's not enough income in the lower quartiles in terms of generating meaningful revenue. Everybody should expect things to go up a little bit, but the bulk of any increase is going to have to come from the higher incomes. Key factor this year, you talked about the big tax bill. At the end of this year, the Trump tax cuts from the first term expire. And if nothing is done, that automatically implies a big tax increase. And what we think is, based on what you saw in the pie chart, it's simply not doable to extend them, certainly, increase them, despite all the rhetoric that you're hearing, because it just, we need more revenue. And I think even Democrats will say we don't want to snap back to kind of the pre-Trump tax numbers. But we think some kind of compromise will be reached this year where you end up somewhere in the middle. So, but effectively, that is a tax increase. And I think that if you do that, you get a long way to addressing the deficit number, certainly make a big dent in it, certainly should create a lot of,
That's cutting the 2 trillion in half, right? By 1 trillion.
So stay tuned on this, but we expect this year that there will be some kind of tax compromise, sure, because there's just not enough votes to extend them fully or even increase them.
And you've seen a couple of Republicans, especially in the House, start to put their hand up on this issue recently. So that's the thing to watch for.
And just a quick snapshot on tariffs. We started out by making a chart showing all the tariffs, and then they were changing so quick, and there were so many of them that was a useless chart to make. But we just pulled up some charts we found while looking on the web, and just a couple points to make. It's more for illustrative purposes, but the U.S. added income tax because they just couldn't generate enough income for the government through tariffs, right? You just can't get enough, because if you keep charging imports, right, at some point people stop importing, and so tariffs have always been limited, kind of in that 3, 4, 5% of GDP range. We've been working at it over 100 years to bring it down because it discourages trade. Fortunately, we've now we're undoing a lot of that. But you really need the income tax to generate meaningful revenue for the government. And then just below, you can see some more things about how dramatically we're changing or undoing some of this progress from the last 100 years, and how it disproportionately impacts certain countries. Certainly, the U.S. is a lot more important to Mexico and Canada than Mexico and Canada are to the U.S. And so that's why you get some of this tension and some of these dialogues. But we're, and then the last chart there is, if you look at some of the language from 100 years ago, we're using approaches that were in vogue a long time ago, and they didn't really work out.
Yeah, I'll say this at a high level. Most economists don't think tariffs work. We're in that category. At a very base level, they increase prices and they reduce growth in the short term. You could even argue there's a longer term effect to both those effects. And just for 100 years, to Adrian's point, those guys in the bottom right were the last two guys that sort of really pushed it forward as a policy. Economy's changed a lot in 100 years. It didn't make sense till then. It definitely doesn't make sense today. Okay, so final chapter, sort of where are we heading? A lot of pieces here. So new administration, we just finished, first 100 days, moving fast on a lot of fronts, a lot of uncertainty. That hasn't been great. I think you'll see pushback from that from various constituents. You're seeing it already, but you also see it more and more from CEOs, from members of the Congress, and a little bit even from his own cabinet. So we think the sort of height of uncertainty was probably the month of April. As you've heard us say a few times, we think over Q2 that uncertainty will decrease, but it's always going to be part of this administration for sure, as are tariffs. It's something that President Trump believes in, despite sort of economists in our own view. So they will be around in some level for this administration. But I think there's a more level that works for everybody that's sort of in the cards, and how that plays out over the next month or two and getting to that. As we've talked about before, tax policy, i.e., some middle ground between letting the current Trump tax cuts from 10 years ago expire a little bit, but keep some of them around as well. And sort of finding that middle ground to reduce deficit is going to be key. The tariffs will increase the risk of inflation. We talked about before. There's real geopolitical challenges. They've so far been contained from an economic perspective. The reality is the U.S. economy does need immigration to keep moving forward. So the actual bite of the current push towards immigration will be interesting to see how it actually affects the size of the labor pool, which Adriaan pointed out early on is actually in a pretty good spot, and we need that to continue to grow well. The dollar has certainly softened. I don't think it's softened, horribly, but it's been significant. It's worth noting that. And the real question is, if it continues to soften, then it will be more of a negative, medium, and longer term reaction. And that gets us sort of 25 economic scenarios, which I think is a good lead to this page. Our base case, as we mentioned before, is sort of lower growth in the last 3 years, but still in that kind of plus or minus 1% range. And a slower year than we had thought at the beginning of this year, but not a horrible year. And again, we're seeing that in the private market. There are those sort of other scenarios that are a little more dire than that. One is stagnation, where prices go up, growth slows, and it's sort of the worst of all worlds.
Yeah, and it's a situation where the Fed really can't go anywhere, right? They can't increase interest rates to kill inflation, because that slows things down further. And so there's a real risk that you could end up here. We're not there. Specifically, I think we have a quarter to kind of calm things down and kind of get back to keep inflation from spiraling out of control, and kind of returning to stronger growth. But yeah, the odds of this scenario have increased. And then finally, a true recession scenario, it's unlikely, we think, at this point, based on kind of our qualitative observations, but also kind of what you're seeing some of the people that take more of a quantitative approach. But there could be a scenario where things become a lot more unstable, and the U.S. really loses control of its ability to borrow, and then you can get into a very difficult scenario, and that will require significant intervention. We think that the odds for that scenario are low, but it's certainly a possibility. Again, our base case is slower, but real growth, real positive growth this year. And then I think the market, the CEOs in this country, the voters, I think are going to speak louder and louder and drive towards a policy that will result in that scenario.
I agree with that. We talked about this before, but we'll just emphasize it one more time, which is really, we really see AI as a driver towards a nice 3 to 5 year cycle. This current volatility notwithstanding, these are factors that will stick around. Again, there's, back to our previous page, hundreds of billions that have invested in AI.
And if you take anything away from this session, is we've really been pleasantly surprised here. We were observing this last year. We were excited about what could come down the road, but quite frankly, we're surprised by what we're seeing right now, that it's really starting to come in. And so again, if things stabilize policy-wise, we really think this could drive us, back to strong growth, and potentially to much stronger growth in the next 3 to 5 years.
And with that, why don't you bring us home, Adriaan?
So in conclusion, things have deteriorated since we spoke to you last. There's a risk that the soft landing that we were also excited about last year is going to come undone. It's not happened yet. This tariff isolation and uncertainty is not a great place to be. And we don't expect it to last. We were expecting a very strong private market, deal making year, and we certainly are seeing that in certain places, and it certainly hasn't, completely slowed. But the big wave, I think, has been delayed into the second half of this year. We're still very optimistic about the long term of this growth cycle we just talked about. Our base case is, slow down with positive growth. The US has definitively changed its posture, to a much more aggressive, positioning, that is, putting stress on things, and then we are, watching that, and we'll see how it will impact things. Net, Q1, Q2, slowdown. Think second half of the year will return to positive growth. So, and we'll do another update sometime this summer, and then I think we should have a lot of further clarity at that point.
Yeah, in the meantime, we've been reasonably active on the deal side. If you see anything interesting, please bring it our way. And please give us any feedback on this session. You reach out to me or any of us at Progress. We like doing this. We've been active and we'll continue to be active in the market. Thank you for joining us, and we'll look forward to talking to you next time.